The first time I left a job, I didn't roll over my 401k. I cashed it out. $4,000 sitting in an old employer's plan, and it felt like my money, just sitting there, so I clicked a few buttons and had it deposited straight into checking within a week. It felt responsible, actually, consolidating things, tidying up, closing a loose end from a job I didn't work anymore. Tax season came, and by the time federal taxes, the early withdrawal penalty, and the rest of my particular situation were accounted for, that $4,000 decision cost me close to $1,400, money I'd never see again, for a decision that took about 90 seconds to make, and honestly, close to a decade to fully understand. That exact number was mine, based on my own tax bracket that year. It'll land differently for anyone else, but the direction is the same for almost everyone who does this. I hadn't done anything reckless. I just never actually understood what that account was, or why cashing it out early was such an expensive way to find out. This isn't a video about which account to pick. It's about actually understanding what these 4 accounts are, in plain terms, so a decision like mine never quietly costs someone else $1,400 for no reason. Here's the myth worth killing first. Most people treat retirement account as one big category, a 401k, an IRA, whatever HR sets up by default, assuming they're all roughly interchangeable versions of the same idea. They're not. Each one answers a completely different question, and the question isn't, how do I save money? It's, when do I pay the tax? Most investment accounts differ mainly in when taxes show up front, later, along the way, or when an HSA is used for qualified medical expenses, potentially not at all. That single question is the backbone of everything else in this video. Sort these 4 accounts by that question instead of by their names, and the whole alphabet soup turns into 4 fairly simple answers, asked at 4 different points in time. We'll cover them in 3 passes. First, the plain, basic version of each one, then the rules that actually govern how they behave day to day, and finally, a few strategies that only become useful once the basics are second nature. Nobody needs all 3 levels on the first watch. The first one alone is enough to walk into an enrollment form and actually understand what it's asking. Traditional accounts answer it with later. Traditional 401k contributions generally go in pre-tax, while traditional IRA contributions may be deductible depending on your situation. Either way, the money grows for decades untaxed and comes out in retirement taxed as ordinary income, the same way a paycheck would be. Picture it in real numbers. Someone in a 22% tax bracket contributing $1,000 doesn't actually feel the full $1,000 leave their paycheck. Taxable income drops by that $1,000, which works out to roughly $220 less owed at tax time that same year, assuming the contribution qualifies for the deduction. This is exactly the account I cashed out early, and here's why that was so expensive. Pulling money out before roughly 59.5 doesn't just trigger the tax that was always eventually coming, it can also trigger an additional 10% tax on top, unless a specific exception applies, for taking the deal apart before it was designed to be used. I paid the tax I owed anyway, plus that additional penalty, for accessing my own money years earlier than the account was built for. Roth accounts flip the order and answer it with now. Contributions go in after tax. No upfront deduction, no lowering this year's taxable income. In exchange, the money grows completely untouched, and in retirement, every qualified withdrawal comes out with 0 additional tax owed, not a lower rate, 0. With a Roth, you pay the tax before the money goes in, and qualified withdrawals later are completely tax-free. With a traditional account, you generally get the tax break today and pay income tax whenever the money eventually comes out. Which one actually works out better depends largely on how your tax rate today compares with whatever rate applies when you withdraw the money. A comparison across 2 different points in time that nobody can know with certainty in advance. The health savings account answers it with something close to never. Available specifically to people on a qualifying high-deductible health plan, it pulls off 3 tax breaks at once that nothing else on this list manages. At the federal level, contributions receive a tax advantage, the balance can grow tax-free, and withdrawals for qualified medical expenses come out tax-free too. And the ordinary taxable brokerage account answers it with, along the way. No special deal at all. Money goes in after tax. And the growth doesn't escape taxation either. Dividends and interest get taxed the year they're paid, and selling for a profit triggers capital gains tax. If all you wanted was the basic answer, you already have it. Traditional means later. Roth means now. HSA can mean never, for qualified medical expenses. Brokerage means along the way. That's genuinely enough to understand what these 4 accounts are for, and enough to walk into an enrollment form without feeling lost. But there are a few details underneath each one that make them far more powerful once you actually understand how they work. And a couple of them are exactly the kind of thing that would have saved me $1,400 if someone had explained them to me sooner. Let's go one level deeper into each account, starting with the rules that actually govern how they behave. The fine print that doesn't change what each account fundamentally is, but absolutely changes how it feels to actually use one. Traditional 401k contributions are automatically pre-tax. Traditional IRA contributions are a little different. The deduction depends on your income, your filing status, and whether you or a spouse are covered by a workplace plan, so it isn't automatic the way a 401k deferral is. Worth checking rather than assuming. There's also a detail that catches people off guard in the moment of an early withdrawal like mine. For eligible rollover distributions from an employer plan paid directly to you instead of rolled over, the plan is generally required to withhold 20% for federal taxes right away before the money even reaches your account. And there's a rule on the other end of a traditional account's life that only shows up decades later. Starting somewhere around age 73 or 75, depending on the year you were born, the government requires you to start withdrawing a minimum amount every year, whether you need it or not. These are called required minimum distributions, and skipping one comes with a real penalty. The government deferred its tax bill for decades. Eventually, it wants to actually collect. Roth accounts, by contrast, the IRA version and, under current rules, workplace Roth accounts too, generally carry no such requirement during the original owner's lifetime, which is really the proof that never and later are genuinely different deals, not just different marketing for the same one. There's a version of the traditional account built for people who work for themselves too, worth knowing exists even if it's not the focus here. Self-employed workers have their own tax-deferred retirement accounts, generally with higher contribution limits than a typical IRA, precisely because there's no employer plan already doing part of the job. The underlying tax logic is identical to a traditional 401k. Only the paperwork and the limits differ. One caveat worth naming on the traditional versus Roth question specifically: the common advice that traditional makes more sense if you expect a lower tax bracket in retirement is a reasonable starting assumption, not a guarantee. It requires correctly guessing your own future income and future tax rates, neither of which anyone actually knows in advance. Someone early in their career often leans Roth for exactly that reason, locking in today's likely lower rate while it's available. Someone at peak earnings often leans the other way. Neither instinct is wrong. Both are just answering pay now or pay later with a best guess. That uncertainty is part of why holding some money in each tends to hedge against being wrong either way. For 2026, the contribution limit on an IRA, traditional or Roth, combined, is $7,500, with an extra $1,100 catch-up once you turn 50. The 401k limit is $24,500, with its own larger catch-up at 50 and an even higher one between 60 and 63. These figures move most years, so treat 2026's numbers as this year's answer, not a permanent one. Roth IRAs also come with an income ceiling. Earn enough, and the ability to contribute directly starts phasing out. One detail specific to Roth IRAs, not Roth 401ks, the IRA version specifically, is worth knowing on its own. The actual contributions, not the growth, can generally be withdrawn at any time, tax and penalty-free, because that money was already taxed before it went in. Only the earnings come with rules about age and how long the account's been open. A Roth 401k follows a different set of withdrawal rules, closer to the rest of a workplace plan, so this flexibility doesn't automatically carry over between the two. Plenty of workplaces now offer both a traditional and a Roth version of the same 401k, and choosing Roth for your own contributions doesn't automatically tell you how an employer match is taxed. Matching contributions have historically landed in a traditional pre-tax bucket regardless of an employee's own election, though newer rules now allow some plans to offer Roth matching too. Worth checking your specific plan rather than assuming. Not every health plan qualifies someone for an HSA, so it's worth confirming directly rather than assuming from the deductible amount alone. It's a specific plan classification with its own IRS-defined minimum deductible and maximum out-of-pocket limits, not just any plan with a high deductible. There's also a similarly named account worth telling apart clearly because the two get confused constantly: a flexible spending account, or FSA. An FSA is an employer-sponsored benefit, generally isn't portable if you leave that employer, and traditionally follows a use it or lose it rule within the plan year, though some plans now offer a limited carryover or a short grace period as an exception to that. An HSA is different on all three counts. It's yours outright, it rolls over indefinitely with no such limits, and it stays yours regardless of where you work. Similar sounding names, genuinely different accounts. For 2026, HSA limits are $4,400 for individual coverage and $8,750 for family coverage, plus a catch-up for people 55 and older. On the brokerage side, the one-year line on capital gains matters more than it sounds. Sell an investment for a profit after holding it less than a year, and the gain is taxed at ordinary income rates, same as a paycheck. Wait just past the one-year mark, and the identical gain typically gets taxed at a noticeably lower rate instead. Nothing about the investment changed, just the calendar did. Losses count too. They can generally offset gains elsewhere in the account, and a limited amount can offset ordinary income as well. So a down year isn't purely bad news from a tax standpoint. A couple of quick questions worth answering directly here because they come up constantly. Can you own more than one of these at once? Yes. For most people, eventually, that's exactly the point. A 401k through work, an IRA on the side, an HSA if a high deductible plan applies, and a brokerage account for anything beyond that, all able to coexist, though eligibility and deduction rules for each one still depend on your own income and coverage. Which one should come first if there isn't enough to fund all of them at once? That's a sequencing question rather than an explaining one, and this channel has a full video dedicated to that exact order. And if a real emergency hits money sitting in one of these instead of plain savings, a Roth IRA's contributions come out cleanly, a traditional account comes out with tax and likely a penalty, making it a genuinely poor emergency fund despite technically holding real money, and an HSA comes out tax-free if the emergency happens to be medical. None of that replaces an actual emergency fund sitting in cash, ready without any of these considerations attached. It's just useful to know which of these would hurt least if that fund ever ran short. Now we're getting into the more advanced part, so don't worry if none of this feels immediately useful yet. You just need to know these options exist so that if your own situation ever grows into needing them, you already recognize the name instead of starting from zero. Someone who earns too much to contribute to a Roth IRA directly can often still get there through something called a backdoor Roth, contributing to a traditional IRA instead, where there's no income limit, then converting that same money into a Roth shortly after. One important catch: if you already have pre-tax money sitting in traditional, SEP, or simple IRAs, the tax calculation on a conversion like this can get more complicated, so it's especially worth reviewing your specific situation before doing it. It involves its own paperwork worth getting right, which makes it a genuine case for a tax professional the first time through, but knowing the option exists is often the part people are missing entirely. A related idea, worth knowing on its own, is converting existing traditional money into a Roth on purpose. At any age, during a year your income happens to be unusually low. Right after a layoff, in a gap between jobs, in early retirement before other income starts. Since a traditional balance is taxed on the way out, and a Roth is taxed once going in, paying that tax during a lower income year can allow the conversion to be taxed at a relatively low rate, rather than leaving the entire balance to be taxed at whatever rate applies whenever it's eventually withdrawn. Picture someone between jobs for 6 months, with barely any income that year. Converting a slice of a traditional account during exactly that window means paying tax on it at whatever low bracket that thin year happens to land in, instead of waiting and paying at a normal working year's rate down the road. It's the same pay now or pay later question this whole video keeps circling back to, just aimed at money that already exists instead of a fresh contribution. One caveat worth knowing alongside it: each conversion generally starts its own separate 5-year clock specifically for purposes of the early withdrawal tax on that converted amount, which mostly matters if you're under 59 and a half and might need to touch it early. It isn't a blanket 5-year lock on every conversion, but it's precise enough to be worth confirming with a professional before doing this for the first time, rather than assuming it works exactly like a normal contribution. The HSA has an advanced move of its own, worth knowing even though it rarely comes up in conversation. Most people spend their HSA down every year like a medical checking account. Left alone and invested instead, there's no deadline on reimbursing yourself for a medical expense. Pay a bill out of pocket today, keep the receipt, and reimburse yourself from the HSA years later, tax-free, once the money that would have covered it has had time to grow invested in the meantime, as long as the expense was genuinely qualified and never reimbursed or deducted elsewhere. And after 65, money can come out for any reason at all, not just medical ones, taxed like a traditional account but without the extra penalty. The account quietly becomes a second traditional IRA on top of everything it already does for healthcare. One more advanced note, brief but worth knowing: when investments in a brokerage account pass to an heir after the original owner's death, the cost basis used for future capital gains is generally reset to the value on the date of death. Years of unrealized growth that would have been taxable to the original owner may, as a result, largely avoid capital gains taxation for whoever inherits it, with some exceptions and special rules depending on the situation. A small, quiet reason a taxable account isn't quite as tax disadvantaged over a full lifetime as it looks in any single year. It's not a detail to plan a whole strategy around. It's just useful to know it exists, the same way the rest of this section is. Here's the part almost nobody says out loud, and it's the actual reason any of this matters. The real question was never which single account is the best one. Each of these 4 pays its tax at a different point: now, later, potentially never, or continuously along the way. And that difference is exactly what makes owning a mix of them valuable, rather than picking one and filling it exclusively. Money in a traditional account, a Roth account, and a taxable account, held at the same time, gives you something no single account type can: a choice, decades from now, about which pile to draw from in any given year, based on whichever one creates the smallest tax bill for that year's specific circumstances. Extend that idea across an entire retirement instead of one unusual year. In a year with lower expenses, drawing mainly from the traditional account might keep someone in a low tax bracket entirely. In a year with an unusually large purchase, drawing from the Roth or the brokerage account instead avoids pushing that year's income into a higher bracket than necessary. Nobody can plan every year of retirement in advance with that kind of precision, but nobody needs to either. The only requirement is that the buckets already exist when the choice needs to be made. That's a decision made decades earlier, by whoever bothered to open more than one kind of account, instead of defaulting into whichever one happened to be easiest to set up first. Picture someone retiring with 3 buckets built up over decades, say $600,000 in a traditional account, $200,000 in a Roth, and $100,000 in a taxable brokerage account. Needing $80,000 to live on this year, depending on their other income and tax situation, pulling the entire amount from the traditional bucket could push more of that year's income into a higher tax bracket than necessary. Pulling $60,000 from the traditional account instead, staying comfortably lower, and covering the remaining $20,000 from the Roth adds nothing further to that year's taxable income at all. Same $80,000 spent. A potentially different tax bill, decided in part by which bucket it came out of. A choice only available because 3 different buckets existed to draw from in the first place. None of this required predicting the future correctly either, which is really the quiet strength of the whole approach. Nobody who opened a Roth IRA at 25 knew exactly what tax bracket they'd land in at 70. They didn't need to know. They just needed to own more than one kind of bucket by the time the choice actually had to be made, so the guessing could happen later, with real information, instead of being locked in decades early by whichever single account happened to be the only one they'd ever opened. I didn't lose that $1,400 because I picked a bad investment, or had bad luck, or misread the market. I lost it because I didn't understand, in plain terms, what kind of account I was even holding, or what it was quietly built to do. Nobody sat me down and walked through any of this before I made that decision. I'm doing that part now, layer by layer, in the hope that whoever's watching gets to skip the decade it took me to actually understand it. These 4 accounts were never really about retirement. They were about deciding, deliberately, when you're willing to pay, instead of letting a form you never read decide it for you. If you watch this once and only remember the 4 words, later, now, never, along the way, that's a genuine win, and worth more than most people ever bother to learn about their own accounts. If you come back to it later, once a Roth conversion, or an HSA, or a backdoor contribution actually becomes relevant to your own situation, that's fine too. This isn't the kind of video meant to be absorbed in one sitting and never thought about again. It's meant to be useful twice, once now, for the basics, and again later, whenever one of these details stops being abstract and starts being your actual decision to make. If you've made it this far, you clearly care about understanding money in a way that actually works in real life, not just on a whiteboard. That's exactly what this channel is all about. Every week, I break down personal finance, investing, budgeting, and wealth building into simple, practical lessons anyone can use. If that sounds like something you'd find valuable, consider subscribing. I'd love to have you here. Because the next time you're handed an enrollment form with a handful of unfamiliar acronyms on it, take the extra 5 minutes before checking a box. That form is quietly asking you when you'd like to pay. It's worth actually answering the question, and it's worth a lot less than $1,400 to find out now instead of a decade from now.